Good afternoon, everyone, and thank you for joining us on today's webinar, U.S. Energy Revolution, Alive and Well. My name is Will Hershey of Yorkville Capital Management, and joining me today from Yorkville will be Darren Sharinga, Founder and Chief Investment Officer. It's rather apropos, the title that we had for today's webinar, given that we saw another increased announcement in terms of U.S. crude oil production, and we saw the figure for November 2017 revised to over 10 million barrels a day to 10.06, which actually puts it at the highest level on record ever for U.S. production. So that surpasses where we were in 1970, to put things in perspective. So an interesting time, certainly in the energy space, in the equity space, and we'll get to it. As a reminder, if you have any questions during the course of the prepared presentation, please feel free to type those questions into the bottom right corner of your screen. We'll hold a Q&A session at the end of the call and do our best to answer everyone's question. With that, I will turn the call over to Darren for his prepared remarks.
Thank you, Will, and thank you all for joining us today for our quarterly review of the MLP asset class. So an overview, we'll get right into it, and it wouldn't be right not to deal with the question right up front, which is energy equities have taken a shellacking, or took a shellacking in 2017. Midway through the year, if you looked at exploration and production companies, they almost lost 30% of their value and finished the year down 20%. MLPs finished 2017 down 6.5%. Basically in line with the energy index, which is the S&P 500 energy sector. So overall, energy stocks had an amazing 2016 coming out of the great energy recession of 2015. And then it was good to say energy stocks turned fickle. I think energy investors turned fickle in 2017. And a lot of arguments have been made on what's going on. The FANG stocks are the modern-day version of the Nifty 50 back from the 70s, and the idea of growth versus value. So ultimately, what we believe here at Yorkville is that we need to start to see investors, generalists, come back into the energy space and get interested. And so why are they going to do that? We're going to basically prepare our remarks throughout the presentation around that theme. What will bring investors back in? Because ultimately, as institutional investors or any investor, we have a choice. Where are we going to put our assets to work today, and what's the best way to deploy capital to minimize risk and maximize returns? And so you've had a large run-up in other equity in the United States, especially growth stocks, but even the S&P 500 trading at all-time highs into a 9-year bull run. And then you have this unloved sector right now called energy, which is sort of sending a lot of mixed messages. So we're going to try to cut through some of the noise and present a little bit of the facts. We know what the performance is, and none of us are happy about the performance, but let's now move through performance into some of the facts. And our final thought, again, is that energy exposure should be a strategic allocation in a portfolio. Portfolios should have energy exposure, and if you should have energy exposure, we believe, then again, infrastructure may be relatively a safer way to play that exposure, and because it's a toll road, again, a different business model, it's volume-based, and volumes just hit record levels versus being tied to the commodity production times the price of the commodity equals revenue. So just it's a safer business model in and of itself. Let's move forward and look at one. Well, before you change that slide, one last thing on slide number 2. If you look at it, this is basically looking at January 17 straight through to current, through last night's close in the 27th of February. You can see there's the 4 indexes I spoke to: MLPs, XL equals Energy Index, XOP are exploration and production companies, and WTI is the price of oil measured in the United States. So we are looking at oil here. It declined, and you can basically see all energy stocks, MLPs less so, they're the top line, but decline along with it. We've seen oil bounce back, and basically even your energy stocks that are tied to the price of the commodity haven't moved with it, which is a little unusual. And the next slide is looking at that. It's looking at the same price movement of oil coming out of the Great Recession of '08. So you started your recovery in the first quarter of '09. You could see the price of oil rebounded, so it moved up to the right. Most of all energy sectors move up to the right. And then from middle of 11, so that took a couple of years, 2.5 years, really 2 years, energy peaked in price. Then energy basically moved sideways for the next 11, 12, 13, 14, 4 years. Look what happened with energy stocks. The XLE, which is the S&P 500 Energy Index, moved flat. It basically moves and has a high correlation with the price of oil. XOP, which are your producers again, because of production growth, actually outperformed the price of oil. And then the best performing asset class coming out of it, or energy asset class, were MLPs, and they're the top line there. So MLPs, again, gaining almost 300% from the bottom. So in the current recovery of the price of oil, we haven't seen the movement in the underlying equity prices. And even as we believe oil is going to level out around these levels, I would have said $50 to $60 a barrel. Now it seems to be 65 to 55, move it up by $5 on each end. Oil will move sideways. But because MLPs are, again, based on production growth and their toll roads, we think that the MLP earnings profile will continue to improve. Therefore, cash flow will improve and grow, distributions will grow, and the price of the equity should move up in line with growth of distributions plus current income, again, as we've spoken about many times. So the backdrop is there's a disconnect, again, between what we've seen historically, not even with MLPs, but even with other energy equities and the price of oil. They're not moving in lockstep when their business models dictate that they should move more in line with the price of oil. So there's one of the disconnects that we see currently. The other one that we've mentioned a lot, and it's really important, because this next chart is looking at energy bonds, and more specifically high-yield energy bonds, which are the riskiest, because high yield is issued by companies that are more highly levered. So in a distressed environment, when you have more leverage, it cuts both ways. It's good on the upside. It hurts more on the downside. These are companies that are more likely to go bankrupt. They are the riskier companies. So when you look at what happened from moving into the great energy recession of 15, which peaked at the end of 15, you can see that high-yield bond index dropped from 700 to almost 350, a little above it. That's a 50% loss. Similarly, energy equities lost approximately 50% in that downturn. So ultimately, high-yield energy is going to move in line with equities when things are bad. And in 2015, things were bad because oil got under, what did it get to in its low?
$26, I think, was the low on February 11th,
right.
2016.
So under $30 a barrel, and that is no good for energy companies as a result of the revenues, volumes, times price of the commodity, which went from 100 to 26. Clearly the revenues were cut by 3/4 in that analogy. Bonds went down. What we've seen here, and the purpose for that, so that's in 12/31/15, that's a distressed bond market. Look at the chart. This is not a distressed bond market. Right now it's trading near its all-time high back to 2013, and in fact, it was up in 2016, which cannot be said for energy equities. So there is clearly two different investors here in energy right now. There are fickle equity investors that are uncertain of what is going on, and there are confident bond investors that look at energy companies and look at their balance sheets and look at their structure and see a much less risky structure across the whole energy complex, and that's why bond yields have performed so well. The price of bonds and yields are trading near all-time lows.
You've actually, just to add to that, you've actually seen a similar performance in terms of, we didn't add it to this presentation, but in terms of MLP fixed income in particular, same story. We just haven't shown it here.
Thank you, Will. Looking at the next slide, again, building the case for what will bring investors then back into MLPs right now with the disconnect between oil, stronger balance sheets, strong credit profile, spreads, valuation. A lot of talk is coming around rising interest rate environment, the impact that will have on equities. We've seen volatility spike in the equity markets because of interest rates moving up. We generally the thought, and we have analyzed it, is that all energy-related equities are going to trade off. REITs, utilities, MLPs, certainly your fixed income, which trades at a spread relative to 10-year treasuries. So what we did here is we actually looked at spreads. Instead of just saying on an absolute basis where are yields, let's look at spreads, because spreads, again, go back to that concept I mentioned earlier, that as investors we have a choice. Where are we going to put our money? And so the choice is, are we going to put it into risk-free 10-year treasuries, or are we going to put it into risky assets? And at some point, you'll make a decision based on risk tolerance and income needs where you'll end up allocating money. So spreads take into account rising interest rates, and that's what we want to look at because we're in a rising rate environment. So on this next chart, we're looking at spreads, which would be MLP yield, which sit at 8% right now, less the 10-year treasury, which is at 3%. So you see the spreads are at 5%. That's on the right-hand side of the chart. If you look at that 5%, very few times in the history of MLPs has it been over 5%. And this is going back to 2006, which is, we used Alarian data here for yield, and that's when it's first published. That's why it's an odd number starting mid-year. There's two periods, the Great Recession of 08, the Great Energy Recession of 15. You saw spikes in spreads. Two things happened. MLPs, energy stocks, became distressed in both of those environments, and your yield on your 10 years actually in 08 dropped, and in 15 it basically was pretty flat, trading near all-time lows. So you had a spike in yield, generally speaking, good entry point. And again here with the 500 basis points of spread, or 5% of spread relative to treasuries, that means treasuries can move up a lot on a relative basis, and MLPs still are a good value from how much more income am I going to get from being in MLPs than being in U.S. Treasuries. So at 3%, you can pick up 5% more income from MLPs right now. Very few times in MLP's history have you been able to pick up that spread. Interest rates are up significantly from their lows. Moving on, again, this idea of why and what will bring in new investors into the asset class. Income is a big part of the draw. As we pointed out in the earlier slide, when income is high on a relative basis, generally a good entry point. Income is high on a relative basis right now. When you look at MLPs, which have been beaten up and have not rebounded yet, unlike the other sectors of the equity market, you look at the yield on MLPs at 8.3%, REITs are at 4.7%, and utilities are at 4%. So roughly an additional 4% income an investor can generate by being in MLPs or investing in MLPs relative to REITs or utilities. And REITs and utilities are both trading near, we mentioned this on our last webinar, near all-time highs from a valuation level, almost at record levels. So being on a basis of relatively expensive or relatively cheap, REITs and utilities are relatively expensive, MLPs are relatively inexpensive at this point in the cycle. So on that basis, again, more downside risk on something that's expensive than there is downside risk on something that is less expensive. So again, we think that is part of what will draw investors back in, will be just being rewarded with healthy income and being paid to wait. So the next slide looks at how do MLPs perform in a rising interest rate environment? We published a white paper on this a few years back when interest rates were rising the last time, and investors were concerned what will happen with MLPs. And we did extensive research. Essentially, summarizing it is that MLPs perform in a rising interest rate environment. And this is looking at 10-year Treasury yields from the beginning to the end. So that the black bar is showing where interest rates started, or yields on the 10-year Treasury. In 98 through January of 2000, interest rates went from 4.2% to 6.8%, so roughly a 50% increase in rates. And across the board, you have 50% to 100% increase in rates from beginning to the end. In all of these instances, and there were 5 of them, we're into the 6th one currently, the gold dot is the performance of MLPs over the complete cycle. And all 5 MLPs produced positive returns. And the reason for that is quite simple. MLPs are not fixed income. MLPs have growing distributions. So because there's growth in distributions, not only do you have the yield spread I mentioned in the earlier slide, that is protection against rising interest rates. Growth of distributions is also protection against rising interest rates, protection of your principal value of your investment. Finally, what a lot of generalists would not be picking up on, and we think that is where a lot of the new money will come into the energy sector to drive it higher. We've heard from trading desks there is more interest because of its underperformance last year and the outperformance of other sectors of the economy, and specifically equities. So there have been major structural changes that have actually de-risked MLPs, improved the overall quality of the underlying cash flows, and as a result, reduced the risk profile of MLPs. And there's 4 of them, and 3 are well, all structural, but here we go. The first one, higher coverage ratios. What does that mean? That means that historically MLPs, of their distributable cash flow, which is their free cash flow that they can, the company is taking care of, they're paying all of their bills, they're paying their maintenance CapEx to maintain their pipelines, I'm simplifying it, but their property, plant, and equipment, and this is the money that's left over. So of this money that's left over for shareholders, they then would pay 90% of it out. And that means when you pay 90% out, you have a coverage ratio of 1.1. If you make $1 and you pay out 90 cents, your coverage ratio is 1.1. Coverage ratios are creeping higher, and they have been over the past couple of years. What we see now is MLPs are increasing their coverage ratios to 1.2, 1.3, meaning they're paying out 65% to 80% of their distributions, down from 90%. That's wonderful. That means longer term now, from a structural standpoint, the risk of a distribution cut has been reduced. A company can afford a lot more hits to distributable cash flow and still maintain its distribution than when they're paying out 90% versus 80% versus 65%. That's one thing, distributions are safer. Number 2, as MLPs are paying out less, it means they're less reliant upon the capital markets. Remember, MLPs are pass-through vehicles. They don't retain earnings when they want to. So how do they grow? Well, they build new projects, new pipelines, or they buy them. So build or buy. Either way, if you don't have the money, where are you going to get the money to do that? Because you've paid it to your shareholders, you're going to go to the capital markets. You're going to borrow, or you're going to raise equity, issue equity. And so MLPs will do one of 2 things. The fact that they're now retaining more of their cash flow, that makes them less reliant on the capital markets. They can do more incremental projects on their own that are bolt-on projects that bring in incremental cash flow without having to go back and tap the capital markets, which still can help drive growth even through downturns, which is really important because there are times, it's one of the risks of MLPs, that capital markets, they shut down. They don't just shut down for MLPs. They shut down in a distressed environment for everyone. So that's number 1. Two is simplification of the structure, and MLP structure historically has had a general partner and a limited partner, and the limited partner is where the assets are held and the operations are conducted, and that's where we're investors in a lot of cases, and the GP had a very minority equity interest in the LP, but had something called incentive distribution rights. And IDRs were designed to align the interests of the GP with the shareholders of the LP or unit holders of the LP. And as they continue to grow the amount of distributions per share, they would take higher and higher cuts in for future distributions up to where they would get 50% of incremental cash flow coming in. Well, that's a problem long term when you get to the higher splits, because it makes equity specifically more expensive for the LPs that have to pay 50% out of their cash flow out to a GP. And ultimately the MLP game is really one of the lowest cost of capital wins. How much does it cost me to borrow money? How much does it cost me to issue equity? How much can I build a new pipeline for? And is my return on the pipeline greater than what it costs me to borrow money for or to issue equity? If that's the case, it becomes accretive to existing unit holders. Well, the more expensive either my debt gets or equity gets, the fewer projects make sense for me. So cost of capital is really important to the structure overall. We've basically seen a trend across the whole industry of simplification, rolling up the GP into the LP or the LP acquiring the GP just to get rid of IDRs and to make it easier for investors. The simplification, again, we believe will bring in more investors into MLPs because they're easier to understand than a GP-LP structure. Stronger financial position. The third point, you can see that from the debt markets, the performance of MLP debt, energy debt overall. They're performing well because the balance sheets are in good shape. MLPs and energy companies more generally took their lumps in 15 during the recession. In 16, they issued a lot of equity. They issued a lot of preferred. They paid down debt. They got their balance sheets in order. They improved their coverage ratio. MLPs are in a much better financial position today than they have been in many years, maybe arguably ever, when we look at it. And again, the proof statement there would be just go back to the bond chart. That tells the story. Bonds have held up so well. And then finally, another risk that we always pointed out next to capital market risk was regulatory risk. What happens if an act of Congress removes the MLP structure? Well, the structure is ratified by the the most recent Tax Reform Act under President Trump. So it is a structure that has now has congressional seal of approval again, from 1986 initially, now again in 2017. So we're highly confident that the structure is here to stay, and these four areas of structural changes are really game changers for MLPs and the way they go to the market. What's happened, to put it in perspective, and how these structural changes may have impacted stock price, is what's good for a bondholder is not necessarily good for a stockholder short term. As you're building your coverage ratio, you are not maintaining distribution growth at the same rate that you would have historically. So we've seen a slowdown in distribution growth across the board, which is now starting to pick up again as distribution coverage ratios have again been expanded. MLPs are moving back into a growth mode of distributions. And across our global opportunities strategy, or growth opportunity strategy, we saw mid-teens to mid-20% distribution growth rates across the portfolio. So these structural changes, again, are truly a game changer for the MLP asset class, making investments in MLPs safer. Now, the second part of our talks will be really what will bring investors back in? This is not a distressed asset class, as we pointed out. And we're going to talk on the fundamentals right now, and why would you want to consider having a strategic allocation to MLPs based on, and it needs to be based on a fundamental, or it's a tactical allocation. So the fundamental is the U.S. energy revolution is alive and well, and we can see that here, and today we're going to explore just the areas of growth that are happening across the United States and in our energy complex. So OPEC cuts extending U.S. growth runway. Will mentioned the November numbers just came in at 10.05 million barrels a day. That's the record level of production ever in the United States. Remember, we peaked in the 70s, in the late 70s through the mid-2000s, declining energy production since the mid-2000s when we introduced fracking and could get oil out of unconventional shale plays. We've, over less than roughly a decade, we've become one of the largest energy producers in the world. We'll touch on that in a moment. So the production level and fundamentally, why do we think oil is going to hold up here? We got into trouble in 15 in the global energy markets because we had too much production, we had too much supply, and basically too much production out of the United States. So a good thing became a bad thing when it's too much. And in fact, philosophically, too much of anything is never a good thing. So total non-OPEC supply and OPEC production this year, you can see them there. The numbers are less relevant. Let me not go into the numbers because it'll just be confusing. You look at that relative to the next two bars here, total supply and global demand. This is really important. For 2018 this year, total supply is forecasted 98.1 million barrels per day. Global demand at 98.6 million barrels per day. The final estimated undersupply, 500,000 barrels per day. That is exactly what OPEC was looking for. That's what we've been monitoring for, is when do we get an oil market that's back in balance? And it looks like, all things being equal, that 2018 will mark the year that we'll start to see, we'll see this happen with the OPEC cuts in place, with production growth out of the United States as robust as it is, and with demand coming through the rest of the world. So this is a good thing. This is what we needed. Again, we had oversupply that led to the crisis. The markets, OPEC cuts are working, and we're getting back into a market that is balanced. And actually, an undersupplied market, if it remained like this, we'd see oil back to $100. Actually, a slight oversupply of a few 100,000 barrels, a number of 300,000 is thrown around a lot, is actually a balanced market. So these are the forecasts. That's really good for energy going forward, and specifically it supports the price of oil. The inventory draws a proof statement that the cuts were working. Well, if you have too much, or you're producing too much of any good, and there's not enough customers buying it, what happens? Your inventories build. And if you have a lot in inventory, you don't need to produce anymore, because you're going to sell your inventory before you're going to produce more to add on to your inventory. So the statement and the way we can monitor whether the global oil markets are in balance, the most accurate way is actually out of the United States. It's looking at our crude inventories, and if they're building, that means that the production, we're producing more than the demand is globally, and our inventory levels are growing. You can see on average from 2010 through 2016 that inventory levels did grow slightly, and that again is a balanced market, is generally growing inventories ever so slightly. In 2017, you saw a decline of 55 million barrels rounding for the year. And so the sharp contrast here is generally there's slight growth, and last year there was a decline in crude oil, gasoline, and distillates, which are all three directly related to crude oil. And so negative draws last year versus historical growth. The fee cuts are working. The global market is coming back into balance, which is very important from a macro backdrop. Global inventories. This is when you listen to OPEC, and OPEC read the minutes to their meetings, they were looking for a normalization in inventories as one of the signals when they would look to begin to release some of their production back into the market. And so what we're seeing here is these are our days of oil supply, which takes into account not only the amount of inventories, but the amount of inventories divided by the amount of demand. And that gives you your days of oil supply. It's down 10% since April 2016, which is trending again in the right direction, another indication that on a global basis inventories are being drawn down because we don't have enough oil being produced to meet the global demand. So again, another very positive trend from a macro perspective to support the energy complex and the price of energy in that $55 to $65 range. How does all of this redound to the benefit of the United States? Well, it goes back to our shale revolution, and it's even broader than that. It's just an energy revolution. At the epicenter of the energy revolution is our shale plays. It is alive and well. We are the primary beneficiaries of the global undersupply. There is no region in the world that is bringing on oil as cheaply as the United States can bring on incremental barrels of oil. And what we saw in 2017 on a global basis, the amount of exploration done globally, and you can measure that by the amount of new reserves found on a global basis, were the lowest levels that they'd been since the 1950s, Will, I believe that's the number?
Yes.
Yeah, and it's shocking. So after the Second World War, and demand on a global basis have almost tripled over that period of time. So there's no money being amassed for exploration because no one can compete with the United States. Again, another reason for a long-term strategic allocation to energy in your portfolios. So proof statements of this: U.S. crude oil was timely released today, is hitting all-time highs. Here we're going back to the 1920s. You can see the last time we hit 10 million barrels was in the 1970s in November. We just exceeded that number. So we are into record territory as a country. And we are becoming, and arguably maybe are already, the world's most influential energy producer, especially with the exporting of natural gas through LNG and the exporting of oil. So the U.S. it's a real game changer on a global basis. The production levels are only going higher in the United States. Crude oil production for this year is going to average 10.6 million. So if it averages 10.6 million, we're going to end the year pretty close to the high tens, almost 11 million.
Actually, just because this data just came out right before we got on the call, the EIA stated November is when they expect that we'll actually hit 11 million. So
there we go. Right. So another million barrels of molecules, energy molecules that need to be moved through pipelines and processed, which again benefits MLPs directly because these are the toll roads. So on a fundamental basis, new all-time highs in productions couldn't be better for the toll road operators in any business. It's just common sense. The United States, we put this slide in because it's incredible, especially for most of our investors because we're older. And you look at the United States relative to Saudi Arabia, the estimates for 2019 and even our numbers this year in November, if we hit them, will average 11.2 million barrels in 19, Saudi Arabia's peak production was not even 11 million barrels. So we are producing, will be producing is more oil than Saudi Arabia has ever produced at its peak levels on an annual basis, and that's incredible. The United States was a net importer, had declining energy production from the 80s through the mid-2000s. In a decade, we are the new oil kings, which that's a revolution. That didn't take multiple generations. That was in a 10-year period. We became one of the largest energy-producing nations, and in fact will displace Saudi Arabia as the largest oil-producing nation, and Russia, and Russia is the largest natural gas-producing nation. We already have. So it's incredible where we sit. And again, these are the long-term, getting rid of the noise and fickle investors and everything we're seeing structurally. The MLPs are safer today from a macro perspective. The energy revolution hitting all-time highs in production levels, extremely positive for the toll roads. And then we've had a lot of conversations about how do you position yourself and why active management works too and should be able to add alpha. Is there's different areas that are producing more of the incremental flow, and one of them in the United States, if you haven't heard of it, is the Permian. 2/3 of the shale growth of production growth since 2014 has come out of the Permian, and that is one of the most prolific and lowest cost regions in the United States. So you want to be looking and positioning some of your portfolio around exposure to the Permian Basin, because that juggernaut is going to keep on producing, and they're already running short on infrastructure to continue producing at these levels. So we're actually going to see opportunities in other basins as there are bottlenecks here in the Permian. So again, the understanding the complexities and the opportunities of MLPs is our area of expertise, and seeing the opportunities as well as the risks. The real revolution is in natural gas. We have roughly 50 years of supply of oil, and we have 100 years of supply of natural gas. We, as a country, and from a production level, producers were, natural gas peaked at $15 per MCF. It trades around $2.25 now, and the producers are still profitable. We are driving efficiencies, cost efficiencies through our production, our energy production, both on the oil and the natural gas sides. That's a competitive advantage, and that's coming out of the technology that we're employing in the shale plays to lower the cost, to increase the amount of oil and natural gas we're taking out of the reserves, which are lowering the cost per barrel to do so. So natural gas, we're the world leader in natural gas production. You can see again that from the mid-2000s, the shale revolution, an increase of from roughly 50 to 75. That's a 50% increase in the amount of natural gas we're producing over that period of time. We weren't exporting it yet. We just started exporting last year with Cheniere. You are looking at the gas production, and again, in different areas where oil is coming out of the Permian. Shale production is Utica and the Marcellus, which is over here on the East Coast. So you have different regions are producing different commodities and have different competitive advantages or comparative advantages in doing so. So overall, in summary, before we get into performance, it has been a really frustrating ride from a stock market perspective in energy. It's been not a pleasant experience in the portfolios overall for any energy investor. It's frustrating. We had the great energy recession of 15. We had a great year in 16 of recovery. We had 2017, again, a volatile year, finishing off down in the single digits, but not what investors were looking for, not the same way we recovered coming out of 08 and had a multi-year run. over that period of time, what we've seen is structural changes in the MLP asset class. It's really de-risked MLPs overall, which is de-risked investments in the space. And then finally, we have this energy revolution backdrop. We're producing at record levels in the United States, and that trend is not going to end anytime soon because we have a price advantage. We can produce oil and natural gas cheaper than any incremental supply coming on a global basis, pretty much. So at least on a large scale. So our performance summary, we are, over the past year, when we look at our growth opportunity strategy, which is our flagship strategy, it had market-like returns. And what more can I say? It was really not a great year. On a gross basis, slight outperformance. A lot of our underperformance here was really related to two holdings in the portfolio, two energy service names. When energy service were even hit worse, as you saw, than any other energy sector. Actually, we didn't publish those charts, and that because we run a concentrated portfolio, that was the majority of our underperformance. In fact, all of it, 70-some-odd% of it. So, but still, we produced inline returns with the index. If you look at our performance on a 5-year basis, the Alerian index is actually basically flat. So investors in MLPs have had a tough 5-year go of it. And it reminds me of the S&P 500 when you were looking at the lost decade from the 2000s through 2010, and investors in equities made no money. So you've sort of had a half decade of that in MLPs right now. Through the end of the year, we think that everything has its time in the sun. Fundamentally, we've seen structural reform, and from a macro perspective, we have a wonderful backdrop. So these are not distressed companies. The equities have not performed in line with what we believe is happening on a fundamental level and on a global macro level for the energy space. Looking forward at one of our new strategies that we launched, and this was a couple of years ago now, inception date October of 2015, so it's now just a little over 2 years of age. It really finished in line. It finished down 5% relative to the Alerian index, down 6.5% on an inception to date basis. It's done on a gross basis 12.5% relative to the Alerian at 3.3%. Both of our strategies that we're highlighting here, the growth opportunities as well as our high income MLP strategy, have delivered alpha over longer periods of time and significant amounts of alpha, 600 basis points, 900 basis points, 6% above the index, 9% above the index. Past performance is no guarantee of future performance, as we all know in our business, but it is nice to know that someone's done it before and they have a shot at doing it again. So we're really good at what we do in investing in energy. We believe that for the reasons I've stated numerous times in this call, that a strategic allocation to energy makes sense. It is not a time that we would be pulling the plug on energy. These are not distressed. This is not a distressed environment currently. So that ends my prepared remarks. Will, I'll turn it back over to you, and thank you for being patient.
Darren, thank you for the presentation. We'll start the Q&A portion of the call now. Before we go there, though, I just want to remind everyone that we've once again started to publish our K1 tracker on our website, where if you're invested in any MLPs, you want to see if the K1 has come out for that given MLP. If you want to link to where you can access that K1 report, that can be done on our website along with our dividend and earnings tracker. So we have all of those up and running.
Can I point one thing out with the K1 tracker? It doesn't matter if you're a client of Yorkville's or not. It's just a service we provide to help simplify an investor's experience of investing in MLP. So we publish More talking. We publish the K1s across the board, and that is for 100% of the MLPs, and then the links that you can get to will take you to any MLP K1 that's been produced. So again, that's for everyone. That's at www.yorkvillecapital.com.
Great. So now we'll get right into the Q&A. As a reminder, if you missed our brief little intro, if you have a question, just type it into the bottom right corner of your screen. We'll try to get through as many as we can before we end our call here. So first question relates somewhat to the broader market. Can energy, and more specifically MLPs, perform well in a weak overall equity market environment? And I'll give Darren just a breather for a second, but feel free to chime in. The answer is yes. So we've seen that actually take place in the early 2000s when the tech bubble broke. Significant underperformance in equities relative to other asset classes. MLPs were able to outperform, and I think given what the picture that Darren painted, MLPs have a really interesting growth backdrop behind them. Even though we would argue value stocks in the broader scheme of the market right now because of how they're priced, there really is a growth background there that can take place even if we see a slip up in the broader market, not related to any recessionary type environment. In that situation, if we did see demand for energy come down, then MLPs could in fact be affected, but we would argue they're already pricing in a pretty ugly picture in terms of where they are from a valuation perspective. So I think the short answer is yes, they can perform well. Have they? Yes. Look at the early 2000s. Will they? We don't know.
And we do something internally that we look at on a daily basis as part of our morning call, and that's an upside-downside ratio, just looking at what's the downside potential relative to the upside using historical valuations relative to current fundamentals, distributions. And there's more upside potential than there is downside. Again, going back to peak yield is one way of valuing the companies. I'd say that if you did that same analysis on the S&P or the NASDAQ, there is a lot more downside potential than there is upside potential when you start looking at historical valuation metrics on the indexes. So I'd say on a relative basis, MLPs in energy could outperform just because they've already been beaten up and they haven't recovered the same way. They're not trading at all-time highs. So that's, again, one of those questions where an investor has a decision, what do I do with my capital now? It doesn't matter what's happened beforehand. What do I do with it where I am today?
Okay, great. And then I saw a few of you asking whether the slides will be available. Yes, we will post a replay of the webinar on our website in the coming day or two, so that will be available for you there. Moving on to the next question, you paint a rather somewhat rosy picture of MLPs. What are we missing, or what are the risks that exist currently in the asset class?
Sure. The number one risk that we see in the asset class overall to energy is supply. If there is too much supply, too much of a good thing again is never a good thing, no matter what it is, and including too much energy supply, because it will cause the markets to be oversupplied. And so that is a net bad thing. And so what would cause oversupply? There's a couple of things that will cause oversupply in the market right now. From the supply side, that OPEC decides we're going to put all of our production back in the market. That would be bad for energy, and that would be bad for OPEC. So number two, the U.S. really continues to produce a lot, and actually so much so that they outstrip demand growth. Now, demand growth is forecast out of IEA, EIA, which are a U.S. and then an international counterpart of energy agencies that compile energy statistics and monitor both demand and growth. Demand is growing in the 1.4–1.5 range per annum. So there's a lot of production that can be brought online that is just gobbled up by incremental demand growth on a global basis. And demand growth has been actually on the higher end of forecast because of the global economy is doing so much better now. And the U.S. hasn't experienced a recession since 2008, and we recovered a lot faster than Europe or the emerging markets. But now we're seeing really more of a coordinated global rebound, and that should keep demand going. So the biggest risk that we see here would be supply, and I'd say that would be the biggest risk on energy right now. Outside of that, it looks pretty good. So what are the mitigants to that risk then? Two mitigants that are here. I think OPEC is really experimented, and they did this with the North Sea as well. When North Sea oil production came in, they tried to drive it out of business, and they failed. Unfortunately, they didn't learn from that lesson. They tried the same, and then the North Sea just ended up producing it at a rate that they took their share of incremental growth and have their market share. The United States is in the same position. They tried to drive the U.S. shale producers out of business. They actually made the industry more efficient and lower cost producers. That's a good capital system, or capitalist system should do that. So I think OPEC seemingly now, and everything that we're hearing and monitoring from them, they're taking a much more measured tone. I think they're seeing their role in the global energy markets as price fixers again, right? Where do we want oil to be, and what's that going to take? And remember, when oil dropped to $26 a barrel, every energy producing country around the world, and especially in the Middle East, were hurting. That wasn't working for their budgets. They were running deficits, burning through their capital reserves, issuing bonds. So they're now saying, and at the same time they were producing at record levels, so they're selling their limited supply of energy that is a non-renewable resource for $26, and you can't get that back once it's sold. So I think they're looking at it on a much more rational basis now, saying, okay, 70 works for us. You know, this $60, $70 Brent pricing, not WTI pricing. We're happy with that. And so even looking at some of the recent statements out of OPEC, it's like we'll start to ease our supply back into the market into 2019 now. So and that would work. The demand would come up. The U.S. would still grow at a rate, and OPEC would bring them on, and then everyone would be producing at their maximum levels that they ever have in their history. So, and then the second part of it is there are real disruptions going on around the world. Venezuela is one, and Libya and Nigeria both last year came on and produced levels that we didn't think they were even capable of producing, based on the war-torn natures of those countries. They both are sort of have stabilized, drawn back a little bit from the peaks, and so that is not bringing on any incremental new supply. And even with those new supplies, look what happened with inventories last year. So we think there's just a more, OPEC is changing its role again as sort of price fixers, right? Setting the demand where they like the price of oil to be on a global basis, and everyone else is a price taker at that point. So oversupply is the greatest risk. OPEC is kind of the swing factor in that. Is it Bouncer? Will, do you have anything else?
No, that actually unintentionally, though, answered one of our other participants' questions, which related to the slide we had on over-under supply. That simply took last year's OPEC production and flatlined it. So even though we are seeing declines in Venezuela, and you're hearing about it in the news and the headlines, and you know, could be as much as a few 100,000 barrels, we're not making any assumptions. That's just simply leaving it where it is, and we do find ourselves in an undersupply position for this year. So to answer your question there, and any further downside from any of those three countries Darren mentioned is going to be seen favorably. So on to the last maybe couple questions here as we round up to the end of the hour. What is the risk to MLP dividends? I'll just before Darren goes, I'll just Darren really touched on how the structure has been changed for many of the MLPs, how there's a trend towards removing IDRs, collapsing the general partner. Increased coverage is a huge benefit towards maintaining dividends. So I think on the asset class as a whole, you're looking at very much so a stable dividend environment in terms of where we are now. The 8% yield, 8+% yield that you see on the Alerian, on the Yorkville MLP index, you can generally count on that. That being said, as there always will be, even in the boom, we saw a handful of MLPs cut distributions, and this is where it plays into versus buying an index or buying an ETF, where Yorkville can add value and avoiding distribution cuts, and we've done so historically. There certainly are names out there that have specific issues with them that maybe are more at risk or have the potential for restructuring in a not so shareholder-friendly way. So just to point that back out there, a little bit of a plug for Yorkville and our active management. But generally speaking, the slide that Darren touched on where he went through all the items, MLP distributions are safe, and they're certainly safer than they've been in the last few years at a minimum. So moving on to another question here. To what extent does the increasing output of domestic oil and gas affect an industrial renaissance in the U.S.?
We're seeing greatly, and we are seeing an industrial renaissance underway currently, and the initial players here have been companies that take natural gas liquids and process them into the raw material or components that go into manufacturing processes or to make plastics. And so we have not, the last time these crackers were built in the country and larger chemical plants was in the 70s, and so they're just now coming online. They started last year, they're coming online this year. So a big part of growth and demand for liquids, which natural gas liquids are part of the liquid complex, will be from these crackers, which are really part of an industrial renaissance in the United States. And again, why would some corporation or investors ultimately behind the corporation make an investment in a bet on a factory that has a 30-year life plus? Is because of our competitive advantage. We're the low-cost producers, and we have more supply than anywhere else in the world. So they're doing two things. They're getting close to the supply, and fortunately close to the supply is also the low-cost producer, which is a win-win from an investment standpoint.
Great. So I think we'll do maybe one more question here, as it's almost 3 o'clock. Thank you for everyone's time with us. And it's more of a long-term question, but what does increased electrical vehicle / autonomous vehicle, although that's probably not as related, what does it mean that we're going to see an increased electric vehicle fleet in the U.S. taking market share? What's that going to mean for oil and for MLPs?
Okay.
So I think I'll start, and then Darren, you feel free to chime in. I think there's no question about it, and we've stated this, I think, on our last couple calls. There's no question that in terms of gasoline demand, gasoline usage in the U.S., the U.S. and Europe, we've either peaked or we're about to peak, and we're not going to see a lot of growth there. Where we are going to see growth, and for many years, decades potentially, is out of China and India in terms of gasoline demand, which is going to be a direct benefit for crude oil demand. But I think, and that touches on the oil side of things. So demand, longer term, oil will be very slowly, but more and more phased out of the overall fossil fuel story in the U.S. But when you look at natural gas, which MLPs are just as, if not more so, involved in transportation of natural gas, whether it's via pipeline or via now exports. We just had our second LNG facility up and running in Cove Point. So now we have 2. Natural gas is, and we wrote about this in our MLPB, it's even with renewables taking market share over the next few decades, going to 2050, the expectation is that natural gas is going to be flat to slightly higher in terms of the overall piece of the pie. And that's part of that's because natural gas, such a big component of it, is used for generating power, generating electricity. So even if you want to take it to that level, natural gas is going to directly benefit from more cars becoming electric because there's going to be more power needed to charge those cars. So I think the natural gas story is really an important one and one that we touched on a bit.
I don't disagree. You look at the trends on a global basis, and they are that baseload electrical demand, the fuel that's winning there is going to be natural gas. And renewables aren't good for baseload demand. They're great for incremental supply. But baseload demand will be fueled not by coal, which is dirty, and even China doesn't want coal. So, but natural gas seems to be the winner, cleaner burning fossil fuel. So, exporting of natural gas from the United States, the lowest cost producer in the world, is a longer term trend. And even where we're seeing it is with floating gasification and liquefaction plants. So that means they're actually taking the gas and liquid and making it into a gas and re-importing it into countries. And they're doing that with mobile fleets to save the costs of construction in smaller countries. So it's a really exciting part of the changing energy landscape on a global basis, because natural gas, prior to LNG exports, it was a landlocked commodity. The only way you could move natural gas from point A to point B was through a pipeline. And pipelines were generally within contiguous land masses at best, but generally they're in the United States to Canada, and we have some into Mexico. They weren't going to Europe and they weren't going to Asia. But now that you have LNG exports, we've opened up brand new markets for it. So Europe's been opened up to us. Asia's been opened up. Cheniere just opened a, 20-year
contract with China's state-owned oil company. So, yeah, no, the long-term story, if one of your concerns, one of your risks, it's a very long-term one, is oil usage coming down. Natural gas is going to provide a huge runway for MLPs.
And then just to address that, because that's not one of our concerns, and we're pretty good about getting the macro right here, is that peak energy, peak oil, it's still, mid-40s on a global basis. So you still are looking at another couple of decades plus before you even reach it. And that's an estimate on what peak demand looks like. So it's still it's still decades away, and there's a lot of growth between how much oil is going to be consumed from current levels based on where we get in a few decades. So if I'm not mistaken, I think the number is 30 million barrels more. Yeah. So, and that's on a base of 100 million barrels. So you're increasing that by 30 million barrels. So there's a lot of incremental energy that's going to be needed. And that incremental energy isn't going to come out of the ground at $65. That's going to bring it back in offshore, and oil is going to go back to 100 at some point. But that's longer than where we're at right now. But overall, there's just, recapping here, the MLPs have gone through a structural change that's made them better investments. It's made the distributions more secure at a minimum. And the structural changes with the IDRs just simplifies it to bring more investors in, which are good things for MLPs. Very strong macroeconomic backdrop, especially in the United States. Global growth is very helpful too. We're meeting the incremental demand for energy, and we have a competitive advantage that's not going to go away over that 40-year time frame. So the U.S. will be the incremental producer of oil and natural gas where we can export it for the global markets. and all of that really does redound to the benefit of MLPs in the transportation of energy from point A to point B, or now across the Atlantic or Pacific, depending on the market we're going to. So it's a good long-term story. That's our argument behind and why you want to have a strategic allocation to energy. MLPs may be the less volatile way of doing that strategically. When you're getting income at a minimum, will you wait? So we think that investors will start to come back into the asset class as they feel more comfortable with these things, and they should. To us, as who are experts, and this is all that we do and invest in, we have seen very few times in the history of MLPs when everything is this favorable. I mean, we invested in MLPs when production rates were still declining.
Okay, great. So there are a few outstanding questions. We'll be sure, if your question wasn't answered, that we'll reach out to you directly to provide a response. Thank you, everyone, for joining us on today's call. As a reminder, if you didn't hear, a replay will be available in the coming days on our website, www.yorkville.com. Once again, thank you, and hope to speak to you again in a quarter. Thank you.